Hello, everyone. Welcome to IPS Academy, Institute of Business Management and Research, Indore, Madhya Pradesh, a premier NAC A++ accredited education institute of Central India. I am Dr. Shailesh Singh Thakur, and today we are going to demystify one of the most exciting yet misunderstood topic, the stock market. Have you ever wondered how companies like Reliance or Infosys grow so big, or how ordinary people like you and me can own a piece of these companies and grow our wealth? Well, the answer lies in the stock market. By the end of this session, you all understand what the stock market is and how it works. Key terms like IPO, dividends, and bull versus bear markets. How to start investing even with small amounts, and common mistakes to avoid as a beginner. Let us understand what is stock market. Imagine the stock market is a giant supermarket, but instead of buying groceries in the market, here we are buying and selling shares. Shares of small companies like Reliance, TCS, Wipro, ICICI Bank. There are so many big companies, even small companies of working in Indian market. You can buy the shares of these companies and have some ownership. The stock market has two key roles. One, companies can raise money by selling its shares to the public. Companies prefer to raise its securities to the general public instead of taking loans. And investors like us, if we want to have some share in the profit of these companies, we would love to invest in these companies in the form of equities. There are two major stock exchanges in India: Bombay Stock Exchange, Asia's oldest and established in 1875, National Stock Exchange, India's largest with tech-driven trading mechanism. It started its operations in 1992. From open outcry system to algorithmic trading, India's stock market journey is incredible. Globally, you have also heard about the stock exchanges like New York Stock Exchange, NASDAQ, where giants companies like Apple or Google trades. But who controls these stock market in India? So SEBI, Securities Exchange Board of India, regulates the market to protect the investors from various frauds or other things. So to understand stock market, you all must have heard about BSE Sensex, National Stock Exchange Nifty 50 on news channels, newspapers, or maybe from friends discussing the stock market. But have you ever wondered what these terms actually mean? Why do news anchors get so excited when Sensex cross 80,000 points, Nifty hits 25,000 today? So let us understand these market indicators in simple terms. What is Sensex? So basically Sensex means sensitive index. It is India's oldest stock market benchmark index. It launched in 1986 by the Bombay Stock Exchange. It tracks the performance of the 30 largest financially stable companies listed on Bombay Stock Exchange. These companies are like Reliance, HDFC, TCS, and so on. Sensex basically covers 12 major sectors of Indian economy. These sectors are basically majorly dominated by banking, cement, manufacturing. So these are the sectors majorly covered in Sensex. If Sensex goes up, it means most of these stocks are rising. Market is bullish. If Sensex falls down, it signals markets are declining. It shows bearish trend. Now let us understand what is Nifty. So Nifty is the benchmark index of National Stock Exchange. It is a flagship index of India. It is launched in 1996. It includes 50 top companies of different sectors of India. It has 50 top traded companies listed in National Stock Exchange. It covers almost 24 sectors of Indian economy. So if Nifty goes up, we says Indian economy is doing good. If Nifty goes down, we assume that Indian economy is not doing pretty good. Do you know how much money moves in the Indian stock market daily? National Stock Exchange and Bombay Stock Exchange daily turnover is more than 80,000 crores per day. This 80,000 crore rupees is more than the GDP of most of the small countries of the world. The trading volume of equity in Indian stock market is 10 to 15 crore shares per day. After COVID 2019, before COVID 2019, there were only 2 crores of demat accounts in India. But nowadays, we have more than 15 crore demat accounts in India. Derivatives, India's National Stock Exchange is the largest derivative exchange of the world. There are highest number of contracts daily traded in stocks, particularly in stock, in National Stock Exchange. Let us understand who regulates this stock market in India. So basically, SEBI, Securities Exchange Board of India, regulates the Indian stock market. It established in 1988 but got statutory power in 1992. Uh, the SEBI's primary role is to regulate the Indian stock market, basically capital market. SEBI regulates stock exchanges also. There is a role of Reserve Bank of India also in controlling, controlling and having a role of watchdog in Indian stock market also. Key functions of SEBI. So as I told you, it regulates the stock exchange of India. It approves new exchanges, rules, regulations, products of stock exchanges. SEBI allows the faster trade settlement. It protects the interest of the investors. It supervises the brokers and mutual funds. It gives license to brokers, auditors, and allows their operations. It controls fraud and manipulation in stock market. It promotes transparency. It runs investor awareness program. Okay, so these all are the functions performed by SEBI to control or regulate the Indian stock market. Now let us understand how stock market works. So here is a small example. Suppose you want to buy 10 shares of Tata Motors and the current price, let's say Tata Motors is 700 per share. So how you are going to buy or sell this stock in stock market? So you should have a trading account and demat account with one of the brokerage firm operating in India. So there are so many brokerage firms like Angel One, ICICI Direct, SBI Capital. There are so many Zerodha, Upstock. There are so many brokerage firms operating in India. You can simply log in to this brokerage firm and have trading account and demat account, and you can start your trading journey. For starting your trading journey, you must have PAN number with you and bank account and Aadhaar card. If you have these three things, you can open your demat account and start trading in stock market. Why you should invest in stocks? So over the long term, stocks outperform fixed deposits, investment in gold, even investment in real estate. For example, if you have invested 10,000 rupees in Reliance company in the year 2000, you know how much it has grown in 2025? It is more than 1 crore rupees. But remember, High return mean high risk. So you should understand the level of risk you can take. The key to invest in stock market is invest for long term. At least you should remain invested in particular stock for more than 5 years. Then only you can gain or think about good return. Key stock market terms. So you all must have heard the term IPO, initial public offering. So basically, initial public offering, company lists its shares into the stock exchange and issue its securities to the general public and raises funds from the public. So IPO, initial public offering, is a mechanism to raise funds by a company from the general investors. You all must have heard the term bull market, bear market. So bull market means when in stock market prices are rising, investors are optimistic. Such market is called bull market. And when stock prices are going down, investors are selling their shares into the stock market. The reason may be so many, the war type situation or any recession. So in the hope of war type situation, recession, people tend to sell their securities. Such type of sentiment is called bearish sentiment. And when in the hope of growth into the economy, growth of the company, people tend to buy the share. Such sentiment is called bullish sentiments. Another important term in stock market is dividend. So dividend is basically distribution of profit. When a company earns a profit, it shares with its shareholders. Suppose a company, for example, ITC, is have earned 10 rupees per share. So they tend to share this profit among the investors. So such type of sharing of profit is called dividend distribution. Another term in the stock market is market capitalization. So basically it is a company's total value. The formula of market capitalization is the current market price of the share and total outstanding shares. So multiply by, so the current market price multiplied by total outstanding of the shares is called market capitalization. So I have already explained how to start investing in stock market. So to start investing in stock market, you should have or you should open demat account, trading account with one of the brokerage firms. And with the help of this brokerage firm, you can submit your PAN card, Aadhaar card, bank details. Nowadays, all these process are 100% online. So you can open your demat account, trading account online, and you can start your trading journey. Before investing in any stock, you should have proper research into the particular investing in the stock. So there are basically two types of research: fundamental analysis and technical analysis. So fundamental analysis is the research of the company's balance sheet. So by reading their company's balance sheet, you read revenue, profit growth, but there are so many ratios, debt to equity ratios, P ratio. There are so many, profit after tax, EPS. So these uh, by understanding these ratios, you can invest in the company. Such type of analysis is called fundamental analysis. Technical analysis. So technical analysis is basically study of charts, its movement of price, volume. So when you study the uh, price behavior of the particular stock with the help of some chart, such type of analysis is called technical analysis. So before investing in any stock, you should you should have some proper research before investing any stock. So this is just a suggestion for education purpose. You should always start your investing journey as a beginner to start investing in blue chip stocks like TCS, Hindustan Unilever, Infosys, SBI, Reliance. So these are basically less volatile shares in which you can invest, and by gaining some experience in the stock market, you should then go to the mid cap or small cap shares. So there is a saying in the stock market: high risk, high return; low risk, low return. So as per the appetite of your risk, you should start investing in stock market. But as a beginner, you should always start investing with blue chip stocks, and you should avoid penny stocks. You should always have long term mindset when you are investing stock market. So stock market is not a get rich quick scheme. You cannot be a richer overnight in investing stock market. Stock market is a game of patience. So you should always uh, have some long term mindset to invest in stock market. So, what should be the holding period in stock market? So, Warren Buffett says that our favorite holding period is forever. So, the longer the view in the stock market, you will have better return. So, this is all about the introduction of stock market. In next series of lecture, I will break down the stock market, and we will study what is primary market, what is secondary market, what is the financial system of India. So all these we are in next series of lectures we will understand. Thank you so much.